In this part, we are going to discuss how to identify trending and non-trending phases of the markets and how to anticipate whether the markets are going to go sideways or they are going to go trending. As an option trader, it is very critical and very important to identify whether the markets are going to be trending or they are going to be sideways. Because when we trade options, we have multiple opportunities, multiple strategies that we can deploy. If markets are trending, and if they're trending and bullish, that means we can buy call or we can sell put. But if markets are trending and bearish, that means we can buy put and sell call. There are two opportunities, right? We can go naked options while trading when markets are trending. But if markets are sideways, then we have to make a different decision, different instrument. Maybe we'll have to go short straddle, short triangles. So this is a way where we trade non-trending markets. So depending, let's say you trade a straddle and strangle, which is a non-directional strategy in a trending market, you will tend to hit stop losses. You might tend to lose when markets are sideways, or maybe markets are trending and you're trading sideways, or markets are sideways but you are trading trending instruments. So the process of figuring out whether markets are trending or they are sideways, they are mission critical for an option trader. As an option trader, you should have an absolute clarity which strategy you are deploying, in which market case or which market condition you are deploying those strategies. None of the strategy is made for every market condition. We have to identify what are the market conditions, what are the market sentiments, what is the trend, whether there is trend or there is no trend. Based on it, we take an informed decision of deploying our strategy. So this strategy is discretionary in nature but rule based. So when I say discretionary, that means the trader has to take a call, but it's rule based. You have set of rules. If they are followed, you know that the markets are trending, you deploy trending strategy. There are certain rules for non-trending phase. When you apply those rules, you will see that the markets are non-trending. You get to an observation where markets are non-trending. You pick out non-trending strategies, maybe not non-directional strategies, which are straddle, strangle, iron condor, and so on and so forth. And based on it, you can trade. So identifying trending and non-trending markets become very important for a trader. And for an option trader, it's absolutely very important to understand in which market phase we are in. So the rules for identifying whether it's a trending market or not, that is through price structure and the indicator that we discussed. So let me break down all the rules for you. For trending markets, we need trend, which comes from a trend filter. We are using moving average as a trend filter. So one data point, we get it from moving averages. The second data set is through market structures. That means we are going to combine price pattern, which is market structure, with indicator, which is the first derivative of price. So as a rule, when we are identifying trend, we see moving averages. If price is trading above moving average, trend is bullish. Price trading below moving average, trend bearish. It's very clear. The second part is forming market structures. So market structure high is a bearish pattern. Market structure low is a bullish pattern. Just a quick revision. Market structure high means you will have two bullish candles, and the third candle is going to be a bearish candle, which is a market structure high. Market structure low means there are two bearish candles, you get two lower closes and one bullish close, or maybe one higher close, which forms market structure low. Now having a conjunction of price pattern plus indicator gives us a very good information. That information is, if trend is bearish and a bearish structure is formed, that means markets are going to be trending and they are going to be bearish. So it gives an absolute clarity to a trader that which strategy you want to implement. Bearish market, trending market, trade naked options, which can be, you can either buy puts or you can sell call. If markets are trending and bullish, that means price is trading above moving average plus forming a market structure low, gives us an idea that it's a bullish market plus a trending market. So you can buy call and sell put. In this course, we are going to discuss about selling options if the trade starts moving in our direction, we tend to trail it and we can trade this positionally. So this strategy is for positional option selling. So the rules for identifying whether it's a trending market or not is very simple and very straightforward. If the trend is bullish and the pattern is bullish, the markets are trending and they are bullish. So based on our understanding that we have learned about trending markets, it becomes very easy for us to participate in the market. That means whenever the trend is bullish, price is trading above moving average and a market structure low is formed, we know that it's a swing bottom. And when we know it's a bottom, we can place the stop loss at the lowest point of the second candle, which is the bearish candle. We can plot the stop loss, or maybe in last 3 candles which is forming market structure low, the lowest point of that structure becomes our stop loss and we can go long from there. We can either buy calls or we can sell put. In the entire course, we are going to discuss about selling options or maybe selling straddles and strangles. So we are going to discuss sell side of options. So when market structure low is formed and the trend is bullish, price is trading above moving average, the moment market structure low is formed, we identify a place from where we see 200 points in the money option. Let's say for example, market structure low getting formed, the pattern gets completed when Nifty is at 19,000 levels. The trend is bullish, price trading above moving average. The MSL is confirmed at 19,000 levels. So from here, we are going to calculate 200 points in the money and we have to short options. That means we have to short put, and that to 200 points in the money. That means we are going to select 19,200 strike as our put option. So put 19,200 strike and we'll go short. The place where we have to go short, we come to options chart of 19,200 put. We plot the chart on 15-minute time frame, plot double moving average, so the high-low band of 21 period moving average. When the put chart is trading below the moving average, forms a market structure high on the 15-minute chart of the put, we go short, keeping high as the stop loss. Very straightforward strategy. So market structure low getting formed on the underlying asset, which is Nifty. If you're trading Bank Nifty, the same strategy can be deployed in Bank Nifty. So instead of trading 200 points in the money, in Bank Nifty we trade 500 points in the money because the normal movement is 500 points in Bank Nifty. The entire idea is of trading 200 points in the money is we have to trade 1% in the money option. That is the entire idea. When Nifty is trading at 19,000 level, 1% in the money becomes 190 points. So I have rounded it off to 200 points. So if Nifty is trading at 19,000 and the trend is bullish, we trade 19,200 put. How we do that? We again come to 15-minute chart, trade the same market structure high on the 15-minute chart of options, which is 19,200 put. Whenever a market structure high is getting formed on the 15-minute chart below the moving average, we go short and we hold on to the trade till the time price is trading below the moving average. Very straightforward and simple. So 200 points in the money is 18,800 call. So we short 18,800 call, and when do we short it? We come to 15-minute chart of 18,800 call. We change the time frame to 15 minutes, trade the market structure high below the moving average and hold on to that trade till the time the price is trading below the moving average on the option chart. So we just take the trend analysis, the swing top and swing bottom on the underlying chart from the underlying chart. So we identify which strike to participate in through the underlying asset. So Nifty's spot chart is going to help us identify the strike of the instrument, the trend and the strike. But once we have identified the trend and strike, and particularly whether we are going to short with call or put, once we have identified that, then we have no use of the spot chart. Then we only come to the options chart, shift that strike price to a 15-minute chart and short market structure high of that chart below the moving average. Every time when we come to options chart, we are only trading market structure high below moving average. Reason is very simple, that we only want to short options. So the strongest pattern in shorting is market structure high. I guess by this time you know the importance of market structure high. So market structure high on the option chart itself is very powerful. Why we are interested in shorting options? Because our accuracy increases multifold. Reason being, below the moving average on the option chart itself gives us a very good entry and a very sweet spot on the chart to participate in the trade. So the method of identifying non-trending phase of the market is by just disaligning pattern in the trend. In the first part, we discussed if the pattern is bullish and the trend is bullish, we get a trending market. Now, just to identify it's a non-trending market, how we are going to do that? We are just disaligning the pattern and the price trend. That means the pattern is bullish but trend is bearish. So bearish trend but pattern bullish, markets will go sideways. Similarly, if a bearish pattern is formed in a bullish market, in a bullish trend, the markets tend to go sideways. So this is a simple way. Now making it more objective, market structure high getting formed above the moving average gets into non-directional market, and market structure low below moving average gets into sideways market. So bullish pattern, bearish trend, sideways. Bearish structure, bearish pattern, but bullish trend, again sideways. So this gives us an idea. So whenever there is a disalignment between pattern and the trend, the markets are sideways. Whenever both of them are in sync, bullish pattern, bullish trend, that means it's a trending market. The moment there is a disalignment between trend and the structure, the markets go sideways. So that's the importance of price structure and indicator. If we combine them together, we get to understand the sentiment of the markets. And based on it, did you see how easy it is to identify whether it's a trending market or a non-trending market? As an option trader, if we just understand this, when the markets are trending and when markets are sideways, understanding this is a gift to an option trader. Based on it, you can deploy your own strategies, you can trade naked call, put options, or maybe you can trade straddle triangles. So you can trade multi-leg chart or a single leg chart by identifying the market phases. So I'm sure now you have got a clear idea of identifying trending and non-trending phases. Now let us move forward and start building this concept on the charts and understand how we can participate in the market, how to participate, when to participate, which strategy to participate, and what should be our stop loss and the risk on the table.